can you or should you just live off of SPYI and JEPQ only? Is that even possible? Is it too risky? I want to talk about the pros, the cons, the risks, and everything in between if someone was to run this type of strategy. Let's get into it. All right, baby. Should you? I mean, I think there's some things here to consider if you were to only work these two funds. And I'm talking about retirement purposes, like living off your distributions like I am now. So let's talk about this. Single stock risk, there is none with either one, right? Because they're both market related. And I do have my notes here, so I will be looking down from time to time. So not having any single stock risk and earnings and this and that, that's great. Now on the flip side of that, you don't get the single stock ripper, right? Because they're all incorporated because they're market related. So, but we want to be more defensive in retirement, I think, and hold our money as best as we can. So no single stock risk. I think that's a great thing. You can laser focus your money into just two funds, right? Not why diversify when the market is already diversified for you, right? So you don't need to spend money elsewhere on other pieces of investment opportunities when you can laser focus all your money into these two assets. I mean, I think that's a good thing. What about being in a market-related fund? Here's the thing. The markets go up over time. It's happened since they've come out. So we can say this with certainty that the markets go up over time. Yes, you could go down for a couple months, a year, years, plural. But over time, the market goes up. So if someone was to tell you, hey, if you get into this asset, it's always going to go up over time, why wouldn't you get into it? We know that we're going to have this value increasing as time goes on. I think that's another great thing. Now, this is kind of like a little personal thing, but how I manage my account, but I can pull 100% of the dividends in most cases, in most market conditions, and feel really good about it. Even if I'm down a little bit on the individual position from a share price standpoint, I feel I can pull 100% of the distributions in most cases, once you get to a share count that you like. Now let's talk about some negatives overall, and then I'm going to break down each of the two funds individually and talk about pros and cons. This is just kind of generally speaking, but again, please let me know your thoughts if you think it's even feasible. Too risky. Here's another good thing, I guess. They're both two different companies. So with NEOS, with SPYI and JEPQ, you won't have that single risk from an individual company. However, if 50% is allotted to JEPQ and 50% is allotted to SPYI, and something happens with those companies, whatever it could be, then yeah, you're going to be in massive trouble if something like that happens. Another negative. Well, they are market related. So if when the market goes down, not if, when the market goes down for a prolonged period, you will definitely feel that from a share price standpoint, and most likely from declining dividends. Now, it's not like a yield max product where you'll be down $1 or 75 cents month over month, right, as we go for a prolonged down period. But you will still have declining dividends as the market's going down. Now, I did a video a while back about showing increasing dividends in something like JEPQ since 2024. Even when we went through the 3-month down crash that we had here recently, over time, since 2024, JEPQ's dividends have increased. That's pretty phenomenal. And when you're on a fixed income, you want those distributions as reliable as possible. Massively fluctuating dividends are not good. JEPQ, let's get into this. Their cons are not tax efficient. They're not like a NEOS fund, right? So you do have some tax efficient. They're not as tax efficient. Obviously a capped upside because they are a covered call fund, albeit the share price appreciation for the covered call fund of JEPQ is pretty nice. Will the distributions keep up with inflation over time? I think that's worth considering and worth thinking about. So here's some big risks, right? Single risk in the JEPQ fund by itself. I think that's a big risk. What about inflation? Will it keep up with their 9% distribution over time with inflation? I don't know, but I think that's worth discussing. Now, what are the pros? Decent share price appreciation with it. Solid, steady distributions that either go up over time or remain relatively flat. Let's talk about SPYI. Here's some pros. They're tax efficient, right? You can look into it and see how they are tax efficient. Go to their prospectus, and you can look at all that. That's pretty important. Okay, another good thing about them is even though they have capped upside, during this crash we had for 3 months, they recovered really, really nicely. And the distributions really didn't go down that much. So again, steady distributions, decent share price appreciation, and both of those are phenomenal when you're on retirement and basically living out of your brokerage account and your distributions. Now here's the cons to NEOS fund. Very, very new. It hasn't been through a ton of different market cycles. Yeah, we had the 3-month crash and it performed well, but how would it do in a 2-3 year down cycle, which will occur? How will that fund perform? Will it reverse split? We know the yield max funds, if that happens, will reverse split multiple times if we go down to like a 3-year period. But these may or may not reverse split. We'll have to see. So that's the problem with them being new. Also, the capped upside. Obviously, you're not going to get the growth, but they're dividend funds, and that's what you expect. So I don't know if I call capped upside a con, but it is. We'll just say that over just buying the Q straight up. So in closing here, I'm not seeing a huge negative of owning just those two that I can foresee, besides the single risk of the individual company, right? Because you have 50% in one, 50% in another. And then I guess another one to think about would be, would their distributions over time keep up with inflation? I don't know. I think it's a fair discussion. I'd love your thoughts. Talk to you guys soon.